Welcome to the 3-Edge Week in Review for the week of September 16th. I'm Fritz, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss this past week's decision by the Federal Reserve to reduce short-term interest rates by 0.5%. This was the first reduction in short-term rates by the Fed in over 4 years. There was a high degree of certainty that the Fed would cut rates at last week's FOMC meeting, but there was also a great deal of debate among investors as to whether the Fed would choose to cut by 1/4 point or 0.5 point. In the end, the Fed chose to lower the Fed funds rate by 50 basis points. So we will discuss the action by the Fed and what it could mean. In the markets this past week, the reaction to the Fed rate cut was muted on Wednesday afternoon, immediately following the Fed announcement. But then the following day, on Thursday, investors decided that the Fed's 50 basis point cut was based on confidence in a soft landing, and markets rose. And then by Friday, Thursday's optimism seemed to give way somewhat to investor concerns over weak earning reports from FedEx, which missed its profit estimates and warned that its business was likely to slow. And in addition, Mercedes-Benz reported weaker sales of its cars due to a slowdown in sales in China. So, Steve, the Fed has finally spoken, literally and figuratively, and they chose to reduce the Fed funds rate by 0.5% on Wednesday. Now, one could argue that this was one of the most anticipated rate cuts in monetary policy history, just because investors have been waiting for what seemed like forever for the Fed to begin to lower interest rates. And the market reaction really has been all over the place. So maybe you could just level set here and put the Fed's action in context for us.
Well, Fritz, right before the Fed cut rates on Wednesday, the Fed funds rate, which is the rate that they lend to banks overnight, was 1.5%, actually more than 1.5% above the U.S. 10-year Treasury rate. Usually, the Fed funds rate is 1 to 2% below the Fed, the 10-year Treasury rate. So it was really out of kilter with where the market was. Also, the Fed funds rate is usually very close to the T-bill rate, and it was over 0.5% above the T-bill rate. So in reality, the Fed was just having to make this move just to get caught up back with where the market already was. Usually, a 0.5% rate cut is a sign of trouble, either in the economy or the markets, and it's a sign that the Fed is kind of panicking or reacting to something that looks really bad. But in this case, they're just catching up with the market. We have a situation with inflation down to 2.5% and unemployment higher than it was a year ago. It allowed the Fed, who has a dual mandate to cover both of those, to focus more on preempting unemployment getting worse.
Okay, I know that you've often referred to how throughout market history, it has been the case that oftentimes an initial rate cut by the Federal Reserve is followed by a period of economic weakness and even recession. Do you think that is what is in store for the economy this time around? Or will the Fed pull off their attempt at a soft landing by successfully taming inflation without causing the U.S. economy to fall into a recession?
Well, the Fed made great pains to say that this is not because they believe we're in a recession, but rather they're doing this preemptively to keep us out of a recession. And that's what got the markets really excited, thinking about that on Thursday. But I think it's worthwhile to point out that in the last 18 rate cut cycles, only one was successful in getting to a soft landing, and that was in 1995. All the other times, it failed. And the reason is that Fed policy always operates with a lag. And if they're data dependent, by the time the recession is in the data, it's too late. And when they start cutting, it takes several months before those cuts really work through the economy. So right now we have a situation where there are some highly respected economists who do think we're on the edge of a recession and might see a recession either later this year or early next year. And if that's the case, then this Fed rate cut is too late because it's going to take several months for this
Right.
Fed rate cut to work through. On the other hand, the market is very optimistic that we will not get a recession and that the Fed rate cut will be in time, and we'll have the so-called soft landing, which rarely happens, but hoping that it happens this time. Now, we're watching, there are two indicators in particular that help us get an early warning on a recession. One is the yield curve, where we match the 3-year Treasury bill rate versus the 10-year Treasury bond rate. And that's certainly consistent with a recession coming soon. On the other hand, we're looking at credit spreads, the difference between low-quality corporate bonds and treasuries. And those credit spreads haven't widened yet in a way that indicates that a recession is imminent. So even there, we have some mixed signals.
All right. As always, my final question is, now that the Fed has finally moved and cut the Fed funds rate by 0.5%, what might investors consider doing, if anything, with their portfolios as we approach the end of the quarter and with the presidential election less than 2 months away?
So on Thursday, the markets were very enthusiastic, as you mentioned. They broke into a new high, and the high originally was back in July. And if this holds, and it's not just a 1 or 2 day wonder, but if this holds and that there's this mass psychology that we call breakout, and so often when a market enters a new all-time high, it attracts more attention and more money, and then you get another surge up. If this high is very temporary and it begins to fall, then all bets are off. But even though the market is so overvalued, that doesn't prevent short-term psychology in crowd psychology from taking over. And so we could get one more burst upward in this rally. And because of that, right now we're still holding our equities that we own. And maybe there's just one more ride up. But keep in mind that there are several risks that haven't gone away, in addition to the fact that the S&P 500 by our measure is highly overvalued. So one is the possibility of inflation rebound. And we've seen inflation go way up over the last period, come back down again now, down to 2.5%. When the market is pricing in that inflation is going to go down to 2% and stay there for the next 10 years. And yet, if we compare this to the inflation cycle of the 1940s and the 1970s, we saw a very similar action, a spurt up in inflation, then a fall back, everyone declaring victory on inflation, and then another rebound in the inflation cycle because the structural inflationary causes hadn't really gone away yet. So that's one risk. Another is geopolitical conflicts are getting worse, not better. And we think of the new axis, the alliance between China, Russia, North Korea, and Iran, and troubles in the Middle East continue to get worse, and oil prices spike. That's a big risk to the market. Third, China is going through an economic slowdown that seems worse than people might have anticipated, and that could drag the whole global economy down. Fourth, if we get tariffs that go up significantly, we know from history that caused trade wars, and that brought the global economy to its knees. Fifth, we have a global debt spiral where interest rates are no longer at zero, and even though they've come down a little bit, the interest expense on the government debt is getting so onerous that it means the government has to borrow even more money to pay off that debt, and you get a bit of a spiral. And that could cause big problems. And then finally, even though the market doesn't expect it, there is still some probability of a recession that could knock corporate earnings. So we'll hold on to equities for now, but watching very cautiously for these risks to come into to play. And the way to hedge the possibilities are in gold, which has been an excellent hedge over the last year, over the last 2 years, and over time. TIPS, Treasury Inflation Protected Securities, because the market is pricing such a low probability of inflation coming back that if it does average more than 2% over the next 10 years, it's a better hedge than regular treasuries. And Shorter term treasuries, like treasury bills, are still a good value because all on the treasury curve, they offer the biggest spread over and above inflation. Longer term bonds are no longer, in our opinion, the best hedge because they would be vulnerable to all the risks that I just mentioned.
Okay, thanks, Steve. As we enter the home stretch and approach the end of the third quarter, and with the U.S. presidential election now less than 2 months away, I want our listeners to know that we will be here every week to seek to help all of us better understand the developments in the markets and the economy. So that will do it for Steve and me for this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. And if you know someone you think might enjoy our weekly videos, please feel free to share them. Also, if you find our weekly videos to be helpful, please feel free to subscribe. We would be most appreciative. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.